first thing that we're going to talk about is derivatives, okay, because that's part of the memo process. And again, you're only going to be doing two types of derivatives trades. It's going to be an up and a down trade, and I'll tell you about that. So based in your memos, depending on if it goes up or down, the derivatives and the derivative language and the trades do not change. The only thing is when it goes up, there's a certain series of trades. When it goes down, there's a certain series of trade. That's it. Okay? It's up or down. Prices can only go up or down in this case, not sideways. We're not going to do that. So there's basically 5 types of derivatives. There are forward contracts, futures contracts, options contracts, and options on futures contracts. And the 5th one we're not going to talk about because it's more advanced, but I'll present it later in the semester, are swap contracts. Okay, where you're swapping one currency for another, one interest rate for another. You're swapping maybe an index return for the LIBOR plus some premium, which is the London intermarket offering rate, which a lot of the derivatives are priced off of, particularly the swaps and the forward contracts. Okay, what is a forward contract? It is a custom contract. It is a custom contract between two counterparties to basically set a price over a period of time. So if I'm, if I'm let's say a manufacturer, okay, and I consume a lot of gas and a lot of oil, I'm going to be really concerned if oil prices go up. I can hedge off that oil price risk so that my costs will be subjected to in the future by entering a forward contract. So I will buy a forward contract in the over-the-counter market with another counterparty. I'm trying to hedge off, and I think that prices are going to go up. The counterparty thinks that the prices are going to go down. I'm going to buy the contract, and the other counterparty is going to write the contract. They're going to write it, I'm going to buy it. And we're going to come up with a set price over a custom period of time, and I do not have to liquidate this contract. It will come due, and it will exercise at the end of the period. Investment bankers and large money center banks basically are intermediaries that negotiate the contracts in the over-the-counter market between two counterparties to basically allow them to hedge or go long a market. Again, they trade in the over-the-counter market, which is extremely opaque. It's not regulated, it's not monitored, it's not an exchange. The investment bank originates the contract between the two counterparties, and the two counterparties engage in a contract.
Which is what Southwest Airlines did.
Entered a forward contract with another counterparty, probably negotiated by Goldman Sachs, or JP Morgan, or Wells Fargo, or Citigroup, or one of the large money center banks, to hedge off their costs, their petroleum costs. You do have counterparty risk. In the financial crisis, you guys need to focus up here, unless you're taking notes. In the financial crisis, the problem is that people had entered counterparty contracts and they weren't being executed because the counterparty went bankrupt. So one of the biggest problems with forward contracts and entering in contracts in the over-the-counter market is your counterparty's credit may not be solid enough to be able to withstand a stress test like a financial crisis. So the only principals that enter into these contracts are very large corporations with experience with balance sheets and fairly stable income statements. Again, they are settled at the end of the period. So here is an example, and you probably want to focus on this. Here is an example. We're in T1. I want to enter a forward contract over a period of time. It could be a year, it could be 2 years, it could be 3 years, it could be 4 or 5 years. The longer the contract, the more risk there is. So they're probably not going to go out more than 2 years in most cases. I'm going to enter the contract, and I believe that the price of the contract, the price of oil, is going to go up over time. So I want to buy that contract from somebody who's going to write the contract. And at the end of the 2-year period, when oil is up here, right, I'm going to get that price, the differential between the price in which I entered the contract and the price in which the oil is, and this differential right here, which is the increase in the price, the person who wrote the contract has to pay me that money. So basically, I lost money because of the increased costs of my profit margins, but I'm now being compensated by the contract money that will offset the loss in my revenue due to increased costs of oil that I was exposed to. So forward contracts can be used for hedging purposes, for people who are subjected to either oil or energy costs or gold costs or other types of costs.
So why would a publicly traded corporation do that? Because they're messing with their money, the stock money, and using it to buy risky.
It's not risky. These are prudent hedging strategies. This market is highly liquid, backed by large financial institutions. It is a standard hedging technique. It is a standard tool where you are going to take part of your cash flow from your treasury and you are going to buy through the leverage process an exposure through this contract that will compensate you for the increased costs. So it's prudent treasury policies to be able to apply derivatives in a prudent fashion to hedge off market risk. It's prudent, it's done. Google does it, Salesforce does it, Chevron does it. The airline industries use derivatives as applications to hedge off exposures to energy costs in particular. Okay, yeah.
So how much are transaction costs or fees?
The investment bank could make a point on it. So if you're doing a $10 billion contract over a 2-year period, they would make a point, or maybe a half a point, on the notional value. So the exposure or the value at risk in which they've calculated due to rising energy costs, let's say is $10 billion, that will be the notional value of the contract, and Goldman Sachs and maybe the other investment bank will split the fee of 100 basis points or 1 percentage point, and they will get 50 basis points each on the notional value as a fee to negotiate. Okay, somebody else had a question?
Could you please expand what is OTC?
Over-the-counter market? The over-the-counter market?
Yeah.
The over-the-counter market is a private market. It is a contract. I am going to write a binding forward contract between two counterparties written up by securities attorneys between the two counterparties to execute on this trade. So that me, who bought the contract that was trying to hedge off rising costs of my energy, the other counterparty at the end of this time period has lost money and they have to pay me the money based on the forward contract agreement. Those are private markets. These forward contracts are not on an exchange. They are not transparent. They are between two counterparties. They are private and they are legal contracts. Okay?
How do the two counterparty meet knowing the other side could meet my?
Yeah, I'm Southwest Airlines or American Airlines or United Airlines, and I want to hedge off rising costs of energy. I will go to Goldman Sachs, JP Morgan, I will go to my investment banker, and I will tell them that I want to hedge off $10 billion of energy risk. And they will go to their clients, and they will say, who wants to take the offsetting position? Who wants to take the opposing position? And then they will put them together as like a broker. They bring the two parties together, negotiate the contract, bring in the securities attorneys, and then drop the contract agreement and sign it, and now it's binding.
And this exercise with finding and meeting the other side to get into a contract signing, how long is a normal?
It's very quick.
Like in a day?
Yes, could be an hour.
Okay.
Because the investment bankers are going to have a book of clients that are qualified, that they've worked with for the past 20, 30 years. They know what their needs are, and they know that, and if they cannot find a counterparty, they will take the position.
Oh, okay.
They will take the position because they're multi-billion-dollar corporations with a balance sheet. So they have balance sheet capacity to be able to take on that offsetting position. Okay, and then they could, if the trade's going against them, they may offload it to another person, but there's some ethics there.
So if you have data that says the price is gonna go up.
And you've done the forecast, you've hired your data analytics team to basically apply the econometric models to do the forecast. And the Southwest people and the United people say, our econometric team has basically said that energy costs are gonna rise by 10% over the next 24 months. We wanna hedge that off.
But the other party has the same data. I mean, why would they get into the contract?
Does everybody in the world have the same view?
No.
No. So you find people with opposing views. If you're right, you're right. If you're wrong, you're wrong. It's the risk you take. But you're better off being hedged than naked, right? You're better off being hedged, because what if energy prices actually spike 20% and not 10%, and you're not covered? Then your profit margins just drop. Let's say it's linear, just drop 20%. Your stock price is going to get hit. If you have the hedges in place, yeah, the costs go up, but you're getting compensated by the derivative contracts, so you backfill the revenue losses and you can still pay the dividends or pay out the earnings. You're still protecting the payouts, okay?
And I think that the reverse is what is killing most E&P and exploration companies now. A couple of them are not hedged, and because of oil prices dropping, they're just losing money every day.
That's a good
And
point.
It's not sustainable, right?
Yeah, they would have taken the other position. Instead of buying the contract, they would have wrote the contract, okay? When you write the contract, you get the money from the person who's going long or buying the contract, and you put it in your pocket. You get the money, okay? But you hedged it, so that as the prices are going down and your revenue is going down, you have the money to backstop the revenue and continue the dividends and the earnings payouts. You've hedged the risk.
Are these future contracts reported in like companies' annual reports?
They may be in the footnote. I don't know, there's been some modification to the FASB and the GAAP rules for disclosures on derivatives. They do, if the positions go against them, under revenue recognition and the recognition rules, if it looks like the position is going to impair the income statement and start to eat into the earnings or the profits, it needs to be recognized, and then it needs to be disclosed, at least in the footnotes. And if it looks like the position went against them, then they're going to have to write it off, okay, and take the loss.
So why did Southwest use a different entity to do that? So they created a separate entity?
I'm not a tax expert. You know, they may have used another separate entity to offload the exposure and the risk and separate it from the balance sheet.
Okay.
So it's going to be off-balance sheet engineering, financial engineering.
Got it.
Okay, and there's probably legal and tax reasons and immunization, you know, liability immunization is the way they structured it. Okay, and again, these are at the institutional level, and they're usually done negotiated between banks and large multinational corporations. You have futures contracts. Now, futures contracts act a lot like the forward contracts, but they're not forward contracts. They are standardized contracts, and they only trade on an exchange. So they're exchange-based, and they're standardized contracts. They look and smell a lot like forward contracts, but it's a highly transparent market. It's highly liquid. The two main exchanges are the Chicago Mercantile Exchange and the Chicago Board Options, the Chicago Board of Trade. So the Chicago, and these exchanges trade trillions of dollars in these futures and options, and the options on the futures contracts. Trillions. They are the biggest markets in the world. Highly liquid. A lot of people can't play in the forward markets because you have to be institutional, you have to have a big balance sheet, you have to have a reputation, you got to have an income statement, you got to meet all kinds of requirements to play at this level. So the futures contracts does what the forward contracts do, but it basically is a hedging or an exposure instrument really targeted towards retail clients or small businesses, okay? Smaller businesses, maybe between, where they generate 200 million to 40 million, and 200 million to 120 million a year, you know, in gross revenues. Okay, so standardized on an exchange, really targeted to the mid-market type of companies, highly liquid. The contracts are very marketable. You could buy them, you could sell them. They're transferable. And what's great about these contracts is, let's say I took a long position, I thought the prices were gonna go up, but they actually went down, so I'm actually losing money. What I can do is I can buy an offsetting position and cancel the trade. So it's great because you can unwind. This, you're locked in for 2 years here. Here, you can take a position. If the position goes against you, you can take the offsetting position and cancel out the trade. That's what makes these extremely appealing. It's not run by investment banks. Down here, it's the broker-dealer market. Okay, it's the brokers that are trading the futures contracts, and they hold a position in the futures contracts as inventory that they can use to buy and sell to trade the securities to arbitrage. So they're not just brokering the deal, they actually take a position in the contracts, hold an inventory, and then try to trade and create arbitrage profit.
Can you go over arbitrage?
Yeah, arbitrage profit means that if I can buy it here, okay, or the price goes to here, and I bought it here, I can sell it at this price and pocket the money. That's arbitrage. If I think the stock market or the bond market or the oil market or whatever market's gonna go up, if I buy it now and it goes up and I sell it, I just made arbitrage profit. If I think it's gonna go down, I can sell it, wait for it to go down, then buy it at the bottom. I just made money. And I can go back and buy it if I want to. So arbitrage is just knowing where asset prices are gonna go and then profiting from that view. Okay, and there's usually a lot of research and a lot of data analytics that backs up those views, and a lot of data analytics and systems and data that backs up the trades. Okay, that's why I said before, when you're trading these things, especially on the exchanges, you have like 5 monitors in front of you, because if I'm trading, gold and oil, then I'm going to have spot market prices, I'm going to have research, I'm going to have the trading of those instruments, I'm going to have the futures contracts, I'm going to be looking at all of the market, and I will be monitoring it and making investment decisions to arbitrage or protect my clients' interests. So it's all technologically driven these days.
Can I say forwards is the primary market, but futures is the subprimary market?
Secondary. This is
Okay.
the primary, secondary. This
Futures.
is over the counter, custom, opaque, between 2 large counterparties. Broker-dealer, two small counterparties, the broker-dealer and the exchange is the intermediary between the 2 clients. There's no intermediary up here. There's no exchange, it's between the 2 counterparties. There's the exchange is the intermediary here, okay? But you have to put up capital.
There is open market on that though.
Pardon me?
On the futures, you can trade.
Here you can manage, you can look at the open interests, you can monitor the liquidity, you can monitor the trades, you can monitor the prices, you can monitor how many contracts are open, in corn or oil or gas or whatever. So you have a lot of transparency to be able to use technical analysis to be able to trade these markets. A lot of information, highly efficient, extremely liquid. Okay.
And I think one of the main benefits of the futures market is because of the clearinghouse, the credit risk is taken away.
That's
As what we have on the forward.
Justice, good point. The credit risk, these are counterparty risk. The counterparty risk between the 2 parties up here is absorbed by the exchange. So it takes away the counterparty risk by having the exchange as the intermediary. And a lot of the trading groups, the people, the broker-dealers, plug right into the exchanges to get all of the information. We talked about big data financial analytics. Real-time data in continuous time, huge data sets to apply the financial analytics that you're learning in these chapters. Because you can apply it. You're applying all the statistics. You do have to have capital requirements and you have to have experience. Not everybody can trade or buy futures contracts. You have to have capital, you have to have experience, you have to be approved by the broker-dealer under its compliance rules. So it's not easy to trade these things. And the biggest problem with the futures contracts is they settle every day. In the forward market, you settle at the end of the period. You're buying a forward-looking product, but the volatility in the price on a daily basis, one day you settle, you make money, the next day you settle, you lose money. So you have to have the capital to put into a margin account up front. And if you start eating into the margin, you will get a margin call, and you will have to put the money up. If you do not put up the money, the broker-dealer will liquidate your account to make sure that they're not exposed to any losses. So these things trade on a forward basis, pricing basis, but they are settled on a daily basis. So you have to be really good at what you do. You have to have enough capital in there in margin. You got to be watching your positions, and if it turns against you, then you have to buy the offsetting position and close out the position to mitigate the losses. Okay? Options contracts. Again, options contracts are standardized product. They're exchange-based product. You can buy options on the futures contracts. You can buy options on stock. Okay, all the major publicly traded companies on the New York Stock Exchange, particularly the big ones, but definitely the S&P 500, you can probably buy put and call options on those stock. Why would you buy put and call options on the stock? Because you can control a lot of stock through the option contracts without having to put up all that much money. So it's leverage. Okay, it's leverage. So they're standardized, exchange-based. They're really targeted at the retail level for the clients, although a lot of people do trade the option contracts in large institutional block trades. They're small denominations. Each contract is 100 shares. It's highly liquid. The options are highly marketable. You can buy them, you can sell them, so you can trade the contracts. You have to have enough credit. You got to put up some capital requirements when you trade the options, and you have to have experience to be able to trade the options. The key to the options, the value of the options, and the premium of the options. If I'm going to buy an option contract, if I'm going to buy a put option or a call option, I have to put up the premium. I have to buy premium. It's going to cost me the premium. So option contracts are expensive. I have to put money up. If I write the contracts, I get the money. But if I buy the contracts, I have to pay. Okay? So the economics between the option contracts, and here's an example of two options. This is a call option. This is a put option. I can make money in any direction. Let's take the call option first. So I'm going to have to put up the premium to buy the call option because I think the price of that stock is going to go up over time. So by buying the call option, I can lock in the exercise price. So let's say I can buy the stock at a exercise price of $20, but the stock price goes to 40, okay? And it costs me $10 to buy the premium, okay? So I need to break even at least $10 before I can get in the money to be profitable on the option contract. So you have a net outflow right off the bat. Then as the stock price moves up, you hit the break even where it pays back the premium that you paid, and then you are in the money the rest of the way, okay? If the stock price goes down, you don't make any money and you lose the premium. You can exercise the option. Most option contracts last for 3 months, okay? So you have the option. And most of these options are not European options, they are American options. European options are just like forward contracts where it's for a period of time and you exercise it at the end of the period. American options state I can exercise it any time during the 3-month option period. It's more expensive, the premiums are higher because of that optionality that you get to be able to exercise at any time. Okay? The value of the options, and I think maybe somebody has picked the Black-Scholes model in the chapters. If you didn't, I'll probably do it. The two main variables that drive value for option contracts is time. So if I buy the option on January 1st, but it doesn't expire until March 30th, the time value is going to be a lot higher. The other variable that is highly correlated to the value of the option is volatility. So the more volatile the stock is, the higher the probability of that price, the price of that stock, getting in the money. So the more volatile it is, the more time you have, really determines the option value. Okay. I can also make money if I think stock prices are going to go down. I can buy a put option. Okay, I can buy a put option. Again, I'm going to pay the premium, but as the stock price goes down, somebody took the other position, I'm making money as the stock price goes down. So if I think stocks are going to go down, or I think my stock is going to go down, I would buy a put option. I'm going to have to pay a premium, but as the stock price goes down, I'm profiting. Once it gets beyond break even, I'm now in the money, and I'm making money based on my view. You can also write the calls and make money thinking that they're going to go down. You can also write puts as you think they're going to go up. So you can take the opposite position. So when you buy the calls, you're going to make money when stock prices go up. If you think stock prices are going to go down, you're going to buy puts, and as they go down, you're going to make money. If you think that the stock price is going to go up, you could write a put, and they will give you money and you stick it in your pocket. If you think that the stock price is going to go down, you can write a call option. So again, put goes down, call goes up, and then you can write the puts to go up, and you can write the calls to go down. So you have basically two options, two trades that you can use on each direction. Okay, and we talk about that in the memo. I go through these in the memo. Okay, I don't, to deviate, to step back a little bit, I don't talk about, except in the memos, buying stock on margin or going short the stock or selling short, which is one of the two trades in the memo. If I think that the stock price is going to go up, I can buy a call or write a put, or I can buy the stock on margin, which basically means that I borrow money from the bank or the broker-dealer, they lend me the money, and I buy the stock. So I'm using leverage just like a mortgage on a house. Okay, so I can do that. And then if I think the stock price is going to go down, I can sell it short. Okay, which means that I'm going to get the money, and then the stock price is going to go down, and then I'm going to buy the stock back later at the lower price. I just made some money. Okay, so you can do it that way too. Any questions? Go for it.
So when we did, in our case study, when we did the analysis, we saw that the price was going to go up the first 2 months, and then the third month it was going to drop. So what we took, so I took one position, Justin took a different position,
Okay.
and we're trying to figure out. So he took position, the long position after 2 months,
Yeah,
and
yeah.
I took the short position after the third month.
Okay.
Thanks.
Yeah.
So how would you kind of determine that to see which one would be the best at that time?
You would probably break it up the way you did.
Okay.
Again, remember with the option contracts, you're pretty much tied into the 3-month time period to get it done, right? And then the forward contracts you can buy further out. So the futures contracts. So you could trade the options on the futures contracts that go out further than 3 months. So you probably have to buy. You could look at one futures contract and look at the options contracts on that futures contract,
Got it. Okay.
and then trade the options on that long-dated futures contract.
Got it.
Does that make sense?
Yeah, what we did was to buy the call option with two-month settlement,
Okay.
and buy the option with settlement in the Fed market, expecting price to go down.
Okay, so you overlap the option
Yeah,
trades.
so they-
Okay,
yeah.
that's what, it's gonna net out,
Yeah,
right?
yeah.
Yeah, that would be a way to do it.
Yeah.
Go for it.
So if you never exercise the option, is your only loss the transaction cost?
Yeah, if you write the option, you get the money, and if the option expires after 3 months, you get to keep the money, okay? If the person doesn't exercise. If you buy the option and it doesn't make sense to exercise it, then it is going to expire. And the option contracts run in 3-month increments across the year. January, February, March, April, May, June, July, August, September, October, November, December. Those are the four periods in which the option contracts trade.
So what I've seen in the market nowadays is people don't wait till expiration, they just sell it now because of premium.
They exercise it or they get an offsetting position, okay? It offsets it and they close out the trade. Because it's going against them, they're losing money. So what they'll do is they'll take an offsetting position to close out the trade to mitigate the losses. They'll either exercise it, take the loss, take an offsetting position, close out the position, mitigate the loss. That's the beauty of the derivatives, is you can take offsetting positions to cancel them out. Okay, and that's what's used a lot with the futures contracts. Okay, options on the futures contracts. You're going to have an index, maybe the stock market index or the oil index or the gold index or whatever it is. The futures contracts are going to trade based off of that index. Then what you're going to do is you are going to buy and write the options based on the futures prices that are based on the index. That's why they are called derivatives. They are derivatives of the underlying asset. So the options on the futures contracts are option contracts traded on the futures contracts that are traded off of the indexes. Okay, Standard & Poor's calculates the indexes. All right, in most cases, or the New York Stock Exchange or the Chicago Board, Chicago Mercantile Exchange generate indexes to create a futures market, to then create a options market on the futures contracts. And actually the development of these markets go hand in hand with the over-the-counter market. In product and process development and innovation, financial product innovation, it's usually the over-the-counter market that develops first. Once it reaches a certain scale and a certain number of trades, the CME and the CBOT will then create standardized product to then scale and create marketability and then create the secondary market off of it. So the product development starts here and then here, then here, then here. That's the product development cycle in these financial derivative products. So again, the options on the futures are standardized, they're on an exchange, they're for speculators in most cases and small investors. 3-month contracts, they settle, you can settle them during the 3-month period. It tracks the futures price, which is based on the index. You have to pay a premium because it's an option contracts. You can exercise during the period. There's no daily settlement. So there's no daily settlement here. There's no daily settlement here. You have to settle daily here. There's no daily settlement here. This is at the end of the period. This is every day. You can settle anytime. Here you can settle anytime, but you don't have to come out of pocket like you do in the futures contracts if your trade goes against you. Okay, and then the swap contracts are you're just swapping one currency for another currency, one index return for another index return. You're swapping a variable interest rate plus some premium with a fixed interest rate. So maybe I can borrow cheaply in the variable market, but it's really expensive for me to borrow fixed, at the fixed rates. What I can do is find somebody who has a comparative advantage in fixed rate instruments. I have a comparative advantage in variable rate interest rates. I can swap between the two and lower our costs of capital together through swap contracts. I can hedge off risk of currency exposures through swap contracts. I can hedge off exposures through interest rate differentials through swap contracts. So this is a swap contract, and I could actually even trade options contracts on swaps. That's another product innovation and development that's occurred. So these derivatives, this financial engineering, these financial products are being developed for customer needs because they're going to these investment banks and they're asking them to innovate financial products that are going to solve their needs. And that's where the product innovation is. The engineering is the same. The product development process is the same. The marketing process is the same. Everything is the same. The only thing that's different is we're not talking about a tangible product. We're talking about an intangible financial product. Okay?
So I'm just wondering, so the wealth management division of my company, the manages close to $5 billion in assets. They don't do any of this. Why would they not go into this?
It's costly. Because there's the premiums, plus you have to convince. In most cases, the senior management does not have the intellectual capability and they're not trained in derivatives. So it's too complex for them. They don't know how to assess it, they don't know how to trade it, they don't know how to articulate it as part of the treasury policy, they don't know how to communicate it to the board of directors, and they don't know how to communicate it to the stakeholders. So they just allow themselves to be naked and be exposed to market forces. It's a certain level of intellectual capacity to be able to do it. That was the biggest impediment for my index product and my futures and options contracts based on the indexes that I developed. The biggest impediment was intellectual incapacity. People couldn't understand it, it was too complex. They said, forget it, I don't even understand what you're saying, I don't want to know. I've heard bad things about derivatives, I don't want anything to do with them. By saying that, they don't understand it, and they're actually putting their firm and their fiduciary as a fiduciary responsibility at risk. If there are prudent applications of the derivatives that are going to hedge off losses or exposures to rising costs or declining revenues, then you should apply it prudently. You need to hire somebody to help you.
I'm thinking, I mean, they're managing individuals' money, and a lot of people probably not comfortable with a risky investment that.
I cannot sell, if I manage a stock portfolio or a bond portfolio or a mutual fund portfolio, and my client says, I want to hedge off some of the market risk. If they don't have a certain amount of money, $250,000, $1 million in assets, they do not meet the suitability requirements as a accredited or qualified investor. So therefore, I cannot put them into these things, even though it's probably the best thing to do. I can't because they don't have the experience, they don't understand, and they're unsuitable. I could probably put them in an opposite trade or an opposite moving exchange traded fund. I can do a fund, an exchange traded fund that moves in the opposite direction of the Standard & Poor's index. I can do that. I can do that. Let's invest in this exchange traded fund. If the market goes down, we're going to make money on the exchange traded fund and it will hedge off the stock market risk. I could probably do that, but I have to communicate it to them and I got to assess their suitability. And I'll make the recommendations based on their suitability, their risk tolerance, their investment horizon, their age, and their return requirements. Okay, so let's turn that off. Let's breathe a little bit. How are we doing on time?
Good.
Yeah, how long did that take me? Just to kind of
Roughly
get
an hour.
an